crypto altcoin space, if you will. It was about 2019, in the LA scene. So it was like Crypto Windy and Brecky and Stash and like all those old school people. But then I was like, after I did all the research, I was like, I'm just going to focus on Bitcoin. I first found Bitcoin in 2015. And then, like most people, I then fell into well, it's not Bitcoin, it's blockchain. That's the real thing here. And so then I chased the blockchain.
Mark first encountered Bitcoin around 2013. At the time, he was already in tech and investing, and he watched Bitcoin run up to $1,000, only to crash. Like many people back then, he dismissed it as another fad. But by 2015, things shifted. Mark had been exploring ways to protect his wealth outside of the US financial system. He was looking into opening accounts in Panama, even setting up trusts and residency programs abroad. Why? Because he understood something most people didn't. The US banking system was fragile. The 2008 financial crisis had never really been fixed, just papered over with more debt and more money printing.
The fiat system, this debt-based system, is the problem. This never-ending debasement, like I said, the leverage in the system. So I became a gold bug. I'm listening to Mike Maloney and Peter Schiff and those guys. And I was, like a lot of people, still had PTSD from the 2008 great financial crash. And as things started going again, I started investing into investment newsletters, research newsletters, trying to get to understand the markets better and how they worked and how different parts of the market, different assets work together. And I was following a newsletter from it's called Sovereign Man. And it was all about having like this flag theory. So like you wouldn't put all your money in one stock. Why do you have your whole life in one country? If money's digital, why do you need your money in the US banking system? That could still collapse. It never got fixed from 2008. It's only worse than it was before. And so I started buying into that theory, which I still am. And I was in the process of going through one of his attorneys to get a trust set up in Panama so I could get a bank account set up in Panama and I could start working on a residency program and citizenship eventually. That was in 2015. And when so I'm going down this path and Bitcoin came across my plate again. I'd seen Bitcoin in 2013, being a tech guy, an investor guy, kind of came across my plate, didn't really pay it any attention. I was watching it run up to about $1,000 and it collapsed and I kind of forgot about it. In 2015, it kind of came across my plate again. And it was at the time I was trying to set up this account in Panama. And I just realized this is actually what I'm trying to do, which is trying to move money out of the US banking system. So it's like, well, I don't need to go to Panama. I'll just buy Bitcoin. And so I did. That's when I started in 2015. Like with most people, once you start putting some money into it, then your attention starts to follow. So now it's like, okay, well, now I got this. Like, what is it really? What are we doing here? What is this really going to do? How does this work? I think I grasped it at that point a little bit easier than I see people grasping it today because I was very clear on the problem. So for me, the problem was fiat. The problem was debt-based monetary system. The problem was debasement. And only once you are clear on the problem can you understand a solution. So then when I saw the solution, it made sense to me. And I'm like, oh, this is perfect. Exactly what we need. Computer network in the history of the world, never been hacked. Over $2 trillion sitting on an open, basically open source, permissionless network database. We also know that the asset Bitcoin that trades on that is a way to store value. It's the best store of value that we've seen over the last 15, 10, 5, 3, 1 year. And we also know that it's a way that we can transmit value, if we call it that. We transmit money, so I could send you Bitcoin, you could send it back. And I try to make it a little bit bigger because I think what we understand as money, what we understand as value, I think those very definitions will be changing in the future. But that's what I'd say Bitcoin is. It's a way that we can store value, typically our wealth, our energy, in a way that can't be debased from money printing, things like that. It can't be seized or stolen, so it's censorship resistant and it's immutable. You can't change it on me, and if I want to send it to you, nobody can stop it, block it, or prevent it. And again, nobody can inflate it away. And the reason why those are important is, again, if you understand the problem. So the problem is that the governments continue to print an endless amount of money. And I say all the governments. The United States is maybe not even as bad as some of the other countries, like we see what's going on in China, for example. So the countries are constantly debasing the currency, inflating it away. So it protects us from that. We also know that nations around the world are continuing to become more authoritarian The United States has gone a little bit down a different road lately, so we're very thankful for that. But obviously, there's North Korea and there's Afghanistan and there's still China trying to ban it. And so, as nations want to become more authoritarian, they want to censor transactions, limit our ability to spend money, transfer value, and things like that. So that's what Bitcoin is.
Mark makes a key point. Investors don't judge Apple, Tesla, or Google by what they cost in the past. They don't say, well, Tesla was $5, so I missed it. They look forward at what the company will be worth in the future. So why do people look at Bitcoin and ask, but it was $10 once, isn't it too late? Professional investors don't think like that. They think in risk-adjusted returns. When Mark bought Bitcoin at $300, yes, the upside was huge. But so was the risk. Governments could have banned it. Competitors could have outpaced it. It was fragile.
Markets are a way for us to buy something cheaper today than we think it's in the future. So when you buy Apple, Google, Tesla, etc., you're buying it today in hopes that it will be worth more in the future. So you're buying it on a discount to its future cash flows. You're buying it on a PE ratio, a discount to where it'll trade or be valued in the future. But for some reason, people ask this question about Bitcoin, like, but what was it in the past? You don't ask that about Apple or Tesla or Google. So I don't really understand this fascination with it. Obviously, because of the fast rise, people think they missed it. But instead of investing through the rear view, we want to think in the windshield. So the question is, just like Apple, Tesla, or Google, what will it be valued in the future? That's the better question to ask. And so certainly, sure, we all would have loved to buy it at 10 cents or $10 or $10,000. But what I would say from somebody who started buying it at $300, it's a better entry today at 112 or 15,000. And what do I mean by that? Amateurs think about how much money they can make when they buy something. Professional investors always think about the downside or the risk-adjusted entry. The very definition of a hedge fund is to hedge all our positions. So a hedge fund would never take a position without a predefined loss or risk on it. So we think about things in terms of risk-adjusted, right? So a professional investor, a money manager, a fund advisor would think about, I take with things that have a high risk and high reward, I do smaller allocations, and things that are safer, I do bigger allocations, obviously, right? So when Bitcoin was $300 and I got in, like, what an amazing entry, except for what the heck was this? How much risk am I taking? Put a couple $100 in, put a couple $1,000 in, right? Today, pretty much all the risk has been taken away. I mean, now we have the president of the United States buying it. So all those risks that we thought, the competition from L1s is gone. The government's going to make it illegal. That's gone. It's withstood forks. It's withstood all types of regulatory battles. And so most of the risk is gone at this point. So now instead of thousands of dollars, I can put in millions of dollars. I can put in billions of dollars if you have that kind of money. And so from a risk-adjusted standpoint, I can put way more money into it, but at the same time, we still have so much upside available to us. So, I could give you the case, well, I'm sure we can run through the math of, I think it can do a 10x in the next 5 years. So to have the ability to have a 10x in front, in that sort of a time period, 100x, 1,000x into the future, to have that upside, but with almost all the risk gone, allows me to go much bigger. So then I get a much bigger outsized return for my overall portfolio. So that's why I think it's a better entry today than it was even back in 2015.
If Bitcoin captures just 1.25% of the global store of value market by 2030, that would put its market cap at $21 trillion, roughly on par with gold today. And that translates to about $1 million per Bitcoin. That's not pie-in-the-sky speculation. It's simply following the math of global liquidity expansion, Bitcoin's scarcity, and its increasing acceptance as a store of value.
We have to understand that mechanism. So as they continue to print more money, it pushes up all the asset prices. You can look at, in the United States, the S&P 500 and the US median real estate is almost a perfect proxy for the M2 money supply, the global M2 money supply. So as the money supply increases, the S&P 500 and the US median real estate move up at about the same rate. Now, not all assets move up at the same rate. Some are more sensitive to that liquidity. So for example, Bitcoin is about an 8.9 times sensitivity to money supply, global liquidity. Gold is about a 1.5 times. So they move at different rates. Why? Well, Bitcoin is scarce. There's only 21 million, right? So it's a much smaller asset. It's much more sensitive to that. And so what we can do is we can go, okay, we have what we call store of value assets. So after we make money and we hopefully make more than we consume or spend, we save it somewhere. And typically we would save it in what we call store of value assets, which would be stocks, equities, that'd be bonds, that'd be real estate, that'd be cash, that'd be collectibles, fine art, that'd be gold, etc. That store of value assets, that basket of store of value assets, currently today in 2025 is worth about $1,000 trillion, about a quadrillion. Now, as they continue printing more money, that basket gets bigger. Let's just go back through some math. So in 2010, that basket was worth about 300 trillion. In 2020, that basket was worth about, I think it was about 500 or 600 trillion. By 2024, it was worth about 900 trillion. Today, it's worth about a quadrillion. By 2030, that should be worth about 1.6 quadrillion. Where do I come up with that number? Well, one, that was history. But where do we come up with that number in the future? The government, the US government, the CBO, Congressional Budget Office, lays out the budget for the next 30 years. So through 2054, they tell us what the debt will be, what the deficit spending will be, what the budget will be. So we can see what they're projected, and I say projected because they always overshoot the number, but what their projected rate of debasement will be for the next 30 years. So assuming that we continue at this rate that they're projecting, then we can see where the money supply will be and where those store of value assets will go. 1.6 quadrillion by 2030, 3.5 quadrillion by 2040, which sounds insane. Now, we have to understand that not every asset in that basket moves at the same rate because some are more sensitive than others. So, for example, gold's going up at 5 or 6% a year. Bitcoin's going up at 50% a year, right? Because of the sensitivity ratio. So we know that the basket in 2030 will be 1.6 quadrillion. Well, we don't know, but based off of the rate, based off of historical numbers, based off of what the government projects that they'll continue to increase the money supply, it should be around that level. And at the rate of Bitcoin's sensitivity to that liquidity, it should push it up to about $1 million per Bitcoin, right? That's that capture about 1.25% of the global store of value basket. 1.25%. That would put it on par to be $21 trillion. It'd be about on par with gold at that point.
He reminds us that understanding Bitcoin starts with understanding the problem. A broken, debt-based financial system that constantly steals value from savers through inflation. Once you see that clearly, Bitcoin isn't just another asset. It's a necessity. And according to Mark's analysis, the best time to buy Bitcoin wasn't 2013, 2015, or even 2020. It's today. Because today the risks are minimal, adoption is accelerating, and the upside remains enormous.